Hey everybody, Jonathan Rose, active day trader. Volatility is back. We got some movement. For traders, volatility presents opportunity. But let's talk about why the stock market went down today. For me, I think we're getting to a place where it's almost a perfect storm. Tariffs brings uncertainty. Midterm elections in the US, November 10th. That's going to bring some uncertainty. The 10-year future contract, the 10-year, revaluing itself. When the 10-year revalues itself, you're going to affect banks, you're going to affect real estate, it's going to go through the global economy. We have the major disconnect. The major disconnect between the purple, the emerging markets, and the light blue, the SPX. Going back to 2015, you can see how correlated they are. They're moving together. But all of a sudden, in April, S&Ps continue to rally. Emerging markets, most likely because of tariffs, but other political unrest in South America for sure. Emerging markets start selling off. Emerging markets led this move. SPX is catching up. But still, even in this down move, emerging markets are getting hit relative to the US markets. Usually what happens when the VIX goes as high as it is, VIX gets up to 23, what ends up happening is the riskier assets, and if you're going to compare emerging markets to the US stability, there's going to be a higher beta, higher volatility that moves into the emerging markets. Because comparing the two, the US would almost seem as a risk on trade, where people would move to the US during crisis, and the emerging markets will get hit. But it's tough for that to happen now because the emerging markets have gotten hit way before the SPX, and the SPX has so much room to catch up. That's why the market got hit. More importantly, though, is what do we do now? And as traders, I don't want you to do a few things. VIX, I don't want you selling straddles. I don't want you selling naked options. I don't want you trading thinking that the VIX is a mean reverting asset and that all of a sudden it's up to 23, it's going to drop down to 14, so now's the time to sell. It's a common mistake. When the VIX gets high, we want to find names that are undervalued, names that are going to move and their movement isn't reflected in the pricing relative to where the VIX is priced at. Where you can get in trouble is selling options right here. For my members, the trades that I'm really going to suggest are trades that allow us to continually be short the US markets. The only thing I'd be willing to buy, especially speculative, would be in emerging markets. A bias of a short SPX, long emerging markets. But I would even go more granular than that. So that would be the overall bias, right? Short SPX, long emerging markets, and I'd build a portfolio based upon that view. But where I really want risk, where I'd really want traders to use their buying power is earnings plays. Because earlier I talked about that perfect storm, the ZN, the 10-year revaluing itself, November 10th midterm elections, earnings season coming up. It's almost like we have a double catalyst. Tariffs, November elections, and then if we could also throw earnings release. Lots of reasons for these stocks to move. Now, what I want to find is I want to find names going into their earnings that are undervalued relative to the amount they historically move after their earnings. So let me walk you through an example. Here I have Skechers, SKX. I have a tool that I had built because this is exactly how I trade earnings. It's exactly how I trade every earnings season. Here's how it works. Skechers last trade 25. If I go up here, this is wrong. Ignore this. The implied move is $4.24 or 17%. So Skechers going out to the November expiration, the market's pricing in about a $4.24 move up or $4.24 move down. Now, if you don't think Skechers is going to move that amount, you could sell options, sell the straddle, sell the strangle, and play for less movement. You'd be selling volatility. If you think the market can move more than that before these options expire in November, you would buy options, and you could consider buying calls, buying puts, buying a straddle, buying a strangle, any kind of debit. Let me explain why Skechers is an excellent buy right now. The implied move is 17%. Over here, I have the last 4 earnings releases of Skechers. Okay? 7/19, 4/19, February 8th, and October 19th of last year. In the parentheses, it shows you how much the stock moved the day after earnings, if earnings were released at 4 o'clock after the market closed, so the day after, or if the earnings came out before the open, this number is going to be the max it moved that day. So July 19th, it was down about 30%. In April, after the earnings release, again, down about 30%. In February, it was up 12%. And then last year in October, it was up 42, 43%. So what does that tell us? Well, for one, analysts don't have a clue where to value this thing. They've been dead wrong the last 4 earnings periods in a row. Have they learned more? I don't know. The last 2 have been 30, so not really. Things still flying all around. This tool shows where the straddles were. The straddle here busted out, right? Huge. Here it didn't really move. Here it gapped lower in the straddle, and here it touched the bottom of the straddle. So right now, stock's at 25. The options market is pricing at 17% of movement, but the average of the last 4 earnings moves is 30% or 29%. That doesn't make sense to me. Why is there only an implied move of 17%, but the average of the last 4 earnings moves is 28%? Now let's look at the options. I got you on Skechers, 25. Let's look at the $25 strike right here. About 210, call it about 2, so $4.10. On Thinkorswim, you could just look right up here. It's trading at 62% volatility, plus or minus $4. So the straddle is pricing in up to 29 and down to 21. But here's the interesting thing. We already know for a fact, okay? It's not subjective, it's 100% fact. We know how much Skechers moved its last 4 earnings release. We also know on average it moves about 28% if we look at the last 4 earnings releases. Well, $4 of 25 is about what, 17%. Why is it only valuing 17% when the darn thing moves 28% after the earnings? Not only that, earnings is just one of these days, right? I'm pretty sure they don't have earnings 37 days. It's just one day. So the earnings alone might be valued at 20%, 22%. But what about the other 36 days? Should there be no premium in there? That doesn't make very much sense. No. Skechers is priced incorrectly. In this kind of environment, with the volatility in the overall market, we can probably make money on Skechers no matter what it's valued at, because volatility is going higher. When you buy options, you're long volatility. There's going to be more premium across the market. But even if the VIX goes lower, I don't think it matters with this one. I just think the market's got this one wrong. Market makers aren't always right. Gosh, the analysts try to value the stock, and after every earnings season, it moves 30%. So those guys aren't doing too good. I like our chances with these guys. The other benefit is we're not guessing on the direction of the SPX. Buy calls, buy puts. $25, buy the straddle. We could put it on a straddle, $3.95 at 4.30. You could be $4.10 bid for the straddle, $4.05 for the straddle. Leave it in there. Go to work. You come back, maybe you get filled, maybe you don't. But if you don't, no harm, no foul, right? There's no risk. If you do, man, this trade makes sense on so many levels. I think you'll enjoy the ride for 37 days. Hope you like that. My name's Jonathan Rose, owner of Active Day Trader.